Hello, I'm Troy Harmon, Chief Investment Officer for Henssler Financial. I'm joined by Nick Antonucci and Jacob Keene, and this is your market update for June 2018. Guys, we always talk about the stock market. We watch it constantly. It's up currently. The S&P 500 is up about 4.5%, but there is a big divergence between growth and value stocks at the moment.
Exactly, Troy, and it's something you're finally starting to see in the media. You hear it mentioned here and there, but growth has been outperforming value by, what, almost 10%?
A little more than 10%, yeah. Yeah, no doubt. And the thing that's strange is growth is up almost 10%. Value is actually down slightly.
Right. It's something you pointed out. The last time we saw this was
right around 99, 2000.
Yeah, so
the
tech
only
bubble
other
times.
time. Yeah, tech bubble times. We haven't really seen a change of leadership in probably a year now. It feels like tech,
leading the way,
tech,
no
maybe
doubt.
a little consumer discretionary of late has been leading. Not a lot of risk events, a little bit with the volatility, but we're seeing a little bit of that now in Italy.
Exactly. Just last week over the Memorial Day holiday, you saw the yields on the 10-year Italian bond spike up to over 3.5%. They've since pulled back closer to about 3%. A lot of the speculation is that you saw such a spike because there wasn't the liquidity that there typically is with the U.S. markets being closed. A lot of the U.S. buyers weren't in the market to pick some of that.
Yeah, not so much liquidity. Yeah.
Right.
And at the same time, the U.S. Treasury, within a day or so of that, actually spiked lower from over 3% down to about 2.74, I think, at its lowest.
We're
things
since
have
back
normalized.
close, about 293 now, but I think the big focus there is the fact that you are starting to see some flare-ups in Europe once again.
Yeah.
Is Italy going to leave?
Right.
The Eurozone.
Yeah.
Right.
And does that lead to other countries?
Right, and it all started with a political issue that could have turned into the tantamount to a constitutional crisis where Italy couldn't form a coalition government. They've worked that out, and that's really what caused the market to normalize a bit. It's still unclear as to what happens next.
Right. I think there's been some talks of a fiscal expansion in Italy, and I think that's some of the concerns. Are we getting back to that European debt crisis kind of thing where we're not willing to stomach the austerity, we want to just go ahead and spend?
And let's be real, you know, we had the European debt crisis, what, a couple of years ago now? The fact of the matter is
we've had a couple.
Yeah, right? And the thing is, that hasn't gone away. That still exists.
Right.
More or less, they get a bailout, they kick the can down the road, and it's just a matter of time before that flares up again. If you look domestically, things still appear pretty bright. We had a jobs report this past week. 223,000 jobs were added to the economy in the month of May, better than the 200,000 that were expected.
Right.
Unemployment ticked down. Unfortunately, the labor force participation rate also came down. So not exactly what you typically want to see.
And we're in an interesting spot now where you actually have more job openings than unemployed people.
Right.
Yeah.
Which is
that's
just
new.
remarkable.
Really is.
No doubt. Inflation still relatively in check. We had the PCE deflator and GDP announced last week as well. Inflation, the PCE deflator 2%, 1.9 when you take out food and energy, so got down to the
pretty
core.
much in line.
Yeah, it is.
With where the Fed wants to be.
Right, and you know, the Fed's still telling us 4 interest rate increases in 2018. However, the market is saying maybe not so quick. We should get another one June, one in September, and then the one in December is questionable. I've seen it pushed off to as far as March 2019.
Yeah.
So hard to say exactly what you'll get there. Now, looking forward, which is the important part, we still see those rate increases should work through the yield curve. We're seeing CD rates even as close in as 2021 over 3%, but it gets really flat after you get out about 5 years, so it doesn't really look like risk worth taking beyond 5 years maturity dates and fixed income.
And as you mentioned, June meeting, that'll be next Wednesday. We'll hear the latest out of the Fed. We do expect to get a rate increase. I think last time we checked, options implied an 84% likelihood that the Fed does hike rates by 0.25%. So we'll be watching that,
Absolutely.
what that does to markets.
I think that's the story overall, just a tightening. I mean, we've seen the current account, the trade deficit decrease, dollar strengthening a bit here. You know, we got the Fed rolling off their balance sheet. It just feels like a tightening of financial conditions a little bit.
Yeah, no doubt. We'll be watching all that real closely as the remainder of the year goes on. But this has been your market update from Henssler Financial, and we thank you for watching.